Hey everybody, John King with Summit Funding, and I'm here with my weekly Financial Friday update. I do this every single Friday, and I'm talking about financial issues that impact you. So it might be mortgage related. Last week we talked about just the state of the market and what's happening with the economy. Lots of things are changing, so check that out. Information is changing on a regular basis. I'm also doing a series within my Financial Fridays of financial lessons you should have learned in school. And today's financial lesson is, what's a mortgage? It's kind of funny when I say what's a mortgage, because obviously I'm in the mortgage industry. People get mortgages all day long. But I think that there's a lot of misunderstanding of what really is a mortgage. Like, where does the money come from? What does the paperwork mean when I sign it? What happens if I don't make my monthly payment? There's a lot of unknowns about what really is a mortgage. And so I'm going to do a real high level basic overview of what those things are, what is a mortgage, and how that it works. And so the first thing I'll tell you is a mortgage is simply a loan to borrow money against a home. Okay. So you've got a first mortgage and you've got a second mortgage. You technically could have a third mortgage. And people are confused about those statements in general. What happens when you get a mortgage is the lender has a loan attached to your home. And that loan that's attached to your home means that the lender gets paid when you sell the home, or if you don't make your payments, the lender can take the home from you. And you can have multiple people that you owe money to, which is why there's the term first mortgage, second mortgage. And it really legally has to do with who has the first rights to the equity in that home. Now, you as the homeowner, it's your home. But you have debts, you have liens that people have the right to get paid back. And it says, hey, they can't have any of the equity in your property. They can't take extra money. They can't take your property away from you as long as you perform or make payments like you're supposed to do. But what happens is if you don't make your payment, then the bank is going to follow up and basically say, hey, if you don't make this payment, we're going to foreclose on your home. And at the moment of foreclosure is when it matters who's first in line and who's second in line. And that's what a first mortgage versus a second mortgage is the lender who is first in line gets their money first. And they don't have to worry about paying anybody else because they're in line, they can take the house. The lender that you did a second mortgage with, that lender has to pay back the first mortgage in full before they can take ownership of the property. Why does that matter, John? Well, it matters because people misunderstand first mortgage being, well, that's the big one. And my second mortgage is the small one, my line of credit. It's actually who's been on your loan, on your property the longest. And so you could do a mortgage when you buy the house. 5 years later, you get a line of credit. So that's your second mortgage. And then you refinance this first one into a new mortgage. Well, that technically becomes the second loan because the home equity line of credit moves up to becoming the first loan. Now, there's a way we can tap on the shoulder of the guy that has the home equity line of credit and say, excuse me, can I cut in line in front of you and be the new first mortgage? And that's called subordination. And we can get their permission to do that. And I don't want to go too deep into that, but essentially the mortgage is the debt that is owed on the property. And the person who's owed that money has the rights to your home. They can take your home away from you if you don't meet your obligations. And it's actually kind of important to mention, and I do loans in the state of California primarily. And so I'm speaking of California specifically, although I believe this applies in all states. The property taxes are actually what is called a superior lien. In other words, the property taxes can foreclose. The county can foreclose on your home because you didn't pay property taxes, and the bank that holds your mortgage gets nothing. That's actually why the bank requires you to include taxes and insurance as part of your payment. Because if you don't pay your property taxes, the county can foreclose and the bank gets nothing. And if you don't pay your homeowner's insurance and the house burns down, then there's nothing for the bank to sell if you don't make the monthly payment. So that's why we include taxes and insurance in the mortgage for most mortgages. You have choices sometimes, but it's why the bank wants to. It's why the mortgage industry wants to include property taxes and homeowners insurance in your monthly payment. So that's kind of a primer, big picture of what is a mortgage and how does a mortgage lien position work. So I want to talk now a little bit about the difference between a home equity line of credit versus a loan. And the basic difference is still a mortgage. You still borrowed money that is recorded against your home. But a line of credit works like a credit card, and a home equity loan works like your car loan or your primary mortgage, which is that, hey, I borrowed a certain amount of money for a certain amount of time, and I'm going to make payments over that time period until it's paid off. So it just works. How you access the money and whether you have access to the money again in the future is the key difference between a loan and a line of credit. So let's transition to, okay, fine, John, I want to buy a house. I want to refinance my home, and I got to sign a whole bunch of papers. And I got to tell you, most people have no idea what they're signing, and it's gotten worse. Why do I think it's gotten worse? Because with technology, 9 times out of 10, the initial paperwork you're signing, you are docu-signing. I love DocuSign. It's efficient, it's easy, but people don't read anything. They literally click, 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 done. That's kind of scary. Now, I don't think most people would understand the words if they read every single word of what they're signing. I think you should. I encourage all my clients to read every single word, but most people don't understand it. But you should peruse every page and get a rough idea or ask a question about, hey, what roughly does this mean and why am I signing it? And that's what I want to go through on some of these documents and just explaining to you some of the things that you're going to sign when you get a mortgage and why they matter and what they mean. By the way, if you have questions, if you're watching live, please post the questions on the live chat. If you're watching recorded, post questions and I'll get back to them later. But definitely want to make this as interactive as possible. I have a half a dozen people on here right now. And so any of you that are on here now, feel free to post a comment and I'll address the question that you have. So the first thing on paperwork that you sign is the loan application. Now this one's tough because as I put in the comments here, you got to make sure there's no fraud. Well, that's critical because your loan officer sometimes, well, unless I'm your loan officer, I'll be careful how I say this. Loan officers make assumptions. It's a fair statement. Loan officers make assumptions. Humans make assumptions. And sometimes those assumptions can cause major problems for you. So you've got to make sure that the gist of what you're representing is accurate. Now, is everything going to be 100% accurate? It's impossible because, for example, the balance in your checking and savings accounts changes every single day. So it's a snapshot in time. It's what we had from the last documented bank statement or printout that we got on your assets. Same thing with your debts. You might say, well, wait a second. This credit card balance changed by $500 and I paid it down. That isn't what I'm talking about when I say accuracy. It's about, hey, oh, you guys didn't catch the fact that I have, 5 vehicles that are financed in my name that didn't show up on the loan application. Oh, you guys didn't catch the fact that I just bought another house a month ago and it didn't show up on my credit report. That's a gross misrepresentation. And what I'll tell you is it's causing problems for a lot of homeowners. And it used to be it was the bank's problem. It used to be, truthfully, that the bank would say, oh man, we missed that. And Fannie Mae or Freddie Mac, I'll explain their role in a couple minutes, comes back and says, hey, you know what? You guys got a problem. You guys didn't catch the fact that they had this other mortgage or they had these 5 cars. And the banking industry, the mortgage industry would just say, okay, well, we'll do better next time. And they take a loss on it. Problem is right now, the mortgage industry is taking losses on a lot of things and they can't afford to take more losses. So they're actually clawing back against the home buyer. And I've actually heard stories of home buyers being foreclosed upon for misrepresentation. And that can be done. And so what I'll tell you is just make sure hiding something on a loan application, not divulging debts, is a problem. And if it's brought up, not only is it a problem for the lender, but it's a problem for the homeowner because you can have the home foreclosed upon specifically because of misrepresentation. So make sure that there's everything that you owe in general, that, hey, the job that you put on there, that you're still actually working there and that you didn't quit there a week ago, because those are things that can cause problems for you when it comes to fraud and misrepresentation. So there's 2 critical loan disclosures. There's a huge stack of loan disclosures that you're going to sign, and you're going to sign them electronically. You're not going to read any of them. But the one you need to stop on at the beginning is called the loan estimate, or the LE. It's got all the critical terms. It's got everything summarized in 3 pages. And that's critical for you to read and understand what you're agreeing to. It talks about whether it's a fixed rate or an adjustable. It talks about whether the interest rate's locked in. It talks about whether taxes and insurance are included in your payment, whether there's a balloon payment or not. A lot of important details to know. The loan estimate summarizes everything in one place and is the most critical document for you to review. But you know what's sad? It doesn't even require a signature on any of those 3 pages. Like you sign down on the 5th page that has nothing printed on it. And so if you're just going DocuSign and you read the page you signed, there's nothing you're actually reading that you're signing. So make sure you read your loan estimate. The second critical document I want you to pay attention to is your closing disclosure. It's actually almost identical to the loan estimate. It's laid out a little bit different, and it comes at a different time in the process. It comes right before you finish the loan and are ready to close escrow. On a refinance, that's finish out your loan. On a purchase, that means you get your keys. The closing disclosure is the final reconciliation of all of the numbers. So if something started on the loan estimate, that should show up on the closing disclosure, and it should not be materially different, or you should be able to get an explanation of why. So the closing disclosure is absolutely critical. 2 other major documents that you're signing. The next one that you're signing is the note. The note is your agreement to pay back the loan. And it outlines what the interest rate is, how long the loan is, whether they can change the monthly payment ever, or if the interest rate is fixed in. All of the key details are included in the note. Now, here's something important to note about the note. And that is that you can sign, everybody who's on the note, those are the people who this loan is going to show up on their credit reports. The next document is called the deed of trust. Everybody who signs the deed of trust are people who are going to be owners of the home. Those don't have to be the same. Let me explain to you why. Why would you have somebody on the note and not on the deed? Or why would you have somebody on the deed and not on the note? And it's really simple. It comes down to a situation, maybe you've got income that you can't document, and you don't qualify because I can't count that income from that second job. So now you said, Mom, Dad, will you co-sign with me? Well, if Mom and Dad co-sign, they have to be on the note because they're obligated to help make the monthly payments as part of the responsible parties. But you might say, Mom and Dad, I don't want you on the ownership of the home. I'm an adult. I want to be able to make my own decisions on whether I sell or refinance, and I don't want to get your permission to do that. And so I don't want you to be an owner of the property. So they're not on the deed of trust. I'll explain in a second what the deed of trust specifically does, but they're not on the ownership of the property. The opposite could be true. You could be in a situation where maybe it's a married couple and one person has great credit and one person has bad credit. Well, the person with great credit has great income and you qualify just fine with that person's income, and you don't need the income of the party that doesn't have great credit. So we don't put that extra person on the loan. Instead, we just do the loan with the spouse that has great credit and great income. But for estate planning purposes, you want your spouse to be an owner of the property. You want your spouse, in case something happens to you, that they automatically retain ownership of the property. And so the deed of trust is the signatures of all of the people who own the property. And in that case, your spouse would be on the deed of trust because they would be signing that they are an owner of the property and that they allow this loan to be placed on it. But they're not going to sign the note because they're not a borrower. So there's a huge difference between the note is who's borrowing the money. The deed of trust is signed by everyone who's an owner of the property. The deed of trust is actually what allows the bank to take possession or foreclose on the property. It explains in 14 pages all of the circumstances in which a bank can foreclose, why they're going to foreclose, and how the foreclosure process is going to work. So there's a really important thing to understand. If you ever end up in a bankruptcy, hopefully you don't, but if you ever end up in a bankruptcy and you say, oh, I bankrupted my mortgage, you can do that. You can file bankruptcy on your mortgage. But here's what's happening. All you're doing is negating the note. The note is your agreement that you are going to make the monthly payment. So technically, you file bankruptcy, you don't have to make the monthly payment. It doesn't show up on your credit report anymore. by the way, there's more to this, so don't hang up now and think this is the end of the story. Technically, you don't have to make the monthly payment anymore. It doesn't show up on your credit report. So if you were late on monthly payments, who cares? Because it's not going to show up on your credit report. So why make a mortgage payment when you file bankruptcy? You can just keep the house, because the deed of trust never went away. The deed of trust says, look, I don't care who's responsible to make the monthly payment. Maybe nobody's responsible to make the monthly payment. But if I don't get the payment, I'm going to foreclose. So you can file bankruptcy on a home. The note becomes obsolete. The note becomes unenforceable. So you are not responsible to make the monthly payment. But if the monthly payment is not magically made, then the house gets foreclosed upon. So two totally different things. They are not connected to one another. Note is who owes the money and how the terms are of repayment. The deed of trust is simply how foreclosure works, and it's the right to foreclose if the payment is not received. Another document you sign when you're doing a loan, specifically a refinance, is called a notice of rescission, or your right to cancel. This is misunderstood, and I want to clarify what you're signing. So it's when you go in to sign all the paperwork with the notary, and when you're signing all of that paperwork, you're actually legally required to have 3 days on an owner-occupied property that you're refinancing after you sign the paperwork before we can close the loan. So you're signing that paper saying, I understand I have the 3-day notice. And then if for some reason, as you go over those 3 days, you decide, you know what, the numbers aren't what I thought they were going to be, or something changed, and I don't want to do this anymore. You sign a second time in another spot saying, I wish to cancel, and then you send that in, and that cancels the loan. But once you've rescinded the loan, you can't unrescind your rescission. You have to start the loan all over again. So if that's something that comes up, you have that right on a refinance of an owner-occupied property. All right, a few other documents that you sign that I just want to explain when you talk about what is a mortgage. One of them is called an Affidavit of Employment. A lot of lenders use this because there's been a lot of challenges with clients who have said one thing and done another. And so this new document basically outlines saying, I, insert name here, work as, insert name of position here, at, insert name of company here. And nothing has changed about my employment status since the loan application. It continues to go on to say, I have no knowledge of any future reductions in income or decreases in hours, and I have no expectation of quitting this job in the near future. There's a lot of things they're basically having you sign so that later, if you say, oh man, I couldn't pay my mortgage, and the federal government gets involved and says, well, gosh, they shouldn't have given you this loan because you didn't have the income that they used to qualify. We can say, wait a second, you just signed here saying that you have no knowledge that your income was going down. It's kind of like why coffee now says on the side, caution, coffee is hot. Because somebody sued somebody saying, you didn't tell me the coffee was hot. Well, somebody in the mortgage world in last couple of years, specifically with COVID, where maybe they lost their job or they had a reduction in hours. And hey, my paycheck stub said I made this much on average in the past, and you guys never asked me if I expected that to change in the future. And you should have asked me. It's your fault, Mr. Bank, that you didn't ask me that. So it's critical that we as a bank are validating this stuff. So it's becoming more and more important. The same has to do with what's called the Affidavit of Occupancy. All that really says is I agree that this home is going to be one of three things: my primary home, my second or vacation home, or a rental property. And so when you sign that, you're swearing to the fact that it is true, because you might tell me you're going to move into a property and then never move in. Why do I care about that? As a lender, as a lending industry, we care because we give better terms on the place you're going to live. And so if you say, you know what, I was going to live there and I changed my mind the next day, maybe, but you signed an affidavit saying I intend to occupy within 60 days and I intend to maintain occupancy for at least 1 year after I move in. Now, can something change in a day? Yeah, but only if you got new information in that 24 hours will we believe you. Otherwise, we consider it fraud. And it's a really big problem in the industry. And so just be careful about occupancy fraud. Don't represent a property as being a primary home or a rental property or a vacation home when it's not going to be that, because it can cause major problems. And in the deed of trust, we are allowed to foreclose if somebody committed fraud. I don't say it to scare you. I'm just telling you the truth of what you're signing and how a mortgage works. Another document you're going to sign is called the borrower's certification and authorization. And it's a blanket document that says, I certify everything in this application is true and correct. And I give you authorization to double check any of it at any time you want. That means that we might go back to the IRS and verify some information. We might contact your employer. We might update your credit report. There's a lot of things that can be done through the loan process. Again, I don't say this to scare you. I say it as a statement of fact. It's my job as your loan officer to guide you through this process and make sure we don't run into challenges. But there are a lot of challenges through the loan process. And I want to educate you so that you're aware of some of the challenges that can come up and how to make sure we avoid them. So the final thing when it talks about the documents is, what's the role of the notary? I get that question a fair amount. Like, John, why do I have to meet with a notary? What are they doing? The notary is making sure it's you. Think about that. You bought a house. I just invested, not personally, but the mortgage industry just wrote a check for $500,000 for you to have a home. And then we find out 2 weeks later, it was all fraud, identity fraud, and it wasn't really you. So the notary's job is to make sure you are you, and that the person who signed the papers agreeing to all of this is in fact the same person that we thought it was, that nobody did it on your behalf. Nobody did it without your knowledge. Now, there's a cool new industry, there's a cool new regulation coming out called electronic notarizations. And it's not mainstream yet, but electronic notarizations has you doing something like what I'm doing right now, where you're on a Zoom call. I would show you my photo ID. You're on the notary is somewhere else. And then I sign everything right in front of you so that you're watching me sign it. And you know the person who you identified is the person who signed the paperwork. So you'll hear about that more and more in the years to come. But it is legal in a lot of states, and they're continuing to work through the bugs and making it more mainstream. So let's shift gears a little bit. When I want to talk about the topic of what is a mortgage, one of the important questions about what is a mortgage is, where does the money really come from? So let's use my company as an example. Summit Funding is a mortgage bank, which means we do mortgages and we fund the loan ourselves. But the truth is, I'm not writing the check. We are not a depository bank. We don't have money coming in from our checking and savings accounts to loan back out. And the funny thing is, even the banks that do, they loan that money out for car loans and for credit cards, but rarely do they do that for mortgages, because the money for mortgages comes through the federal government, not from the federal government necessarily, but through the federal government. And it's through what's called the government-sponsored entities, or in the industry, we call them GSEs. And a GSE, you've heard them under their real names, which is Fannie Mae, Freddie Mac, FHA, VA. Those are the government-sponsored entities, but they're not providing the money either. They're providing the rules. So Fannie Mae says, you got to check all of these boxes, and if you do, I'll put my seal of approval on that loan that it meets our quality guidelines. It's kind of like the USDA, which is funny because USDA is actually a loan product too. But let's talk about USDA and what they really do. The USDA certifies the agricultural product. Let's use beef as an example. The USDA will certify that beef is of a certain grade. Now, the USDA did not go out there and check every single piece of beef that is sitting on the shelf at Safeway to make sure that it is USDA prime. What they do is they set the rules that say, this is what USDA prime beef means. And then they randomly sample and audit to make sure that the people who are producing that beef and labeling it as prime, that it really is prime. That's exactly what Fannie Mae does. They set the checklist of rules. They randomly audit files and they randomly audit mortgage companies to make sure that those rules are being met. And as long as those random rules are being met, then Fannie Mae says, look, every loan that's produced by Summit Funding that they say meets our rules, we agree meets our rules because all of our random audits have proven they're implementing our rules appropriately. But the money doesn't come from them. The money really comes from Wall Street. Mortgages are packaged up. They're pooled together into an investment package. And so what happens is it's called a bond. And bonds are used for many, many different things. There are bonds used locally to pay for road repairs. The city will package up a bond and they'll say, we need $5 million for repairs of roads in our town. So they're going to sell a bond, which means that they say, hey, Wall Street, I've got $5 million that I need, and I'm going to pay you guys an average interest rate of blank percent. Do I have any bidders? And everybody says, you know what? You're going to pay me 3% interest? Not worth it to me. And if nobody bids, then they say, fine, I'll pay you 4% interest over the next 10 years. And it's a bidding process to determine how much does the investor want to earn in order to be willing to buy that debt. That's what a bond is. That's how mortgages work. Once we fund your loan, we package it up together into an investment and we go to Wall Street. And we say, Wall Street, I got $10 million of loans in a package right here. Do I hear 4%, 4.25%, 5.25%, 6.25%? Basically, it's an auction. And it's a process where an investor buys the loan and you'll never know who they are. It doesn't really matter because when you got your mortgage, the terms were created up front. The lender funded the money and the investor pays them back. Now, every month, the lender collects the money. They're called the servicer. So the servicer is not the one that gave the money. The servicer is the person that collects the monthly payments. Let me say that over again. Your loan servicer is not always the person who loaned you the money. And sometimes it is the same person that loaned you the money, and sometimes it's not. Sometimes your loan gets sold from one bank to another. And the reason why banks change who your servicing is with is because servicing has value to it, to the bank, because the bank gets a cut. They get a little bit of your monthly payment. So whoever you write the check to every month is your servicer. They get a little bit of money. Sometimes they say, you know what, I'd like to trade the little bit of money for over a long period of time for a lot of money right now. And so they sell the servicing. Another bank says, sure, I'll write you a big fat check right now because I'm okay writing a big fat check and getting a whole bunch of small checks for a long time. So servicing is not the same as the person who loaned you the money. Servicing is not through Fannie Mae or Freddie Mac. The servicer is the person who collects your monthly payment. But what happens is the servicer is the person that you talk to when you cannot make your monthly payment. And I want to talk about what happens when you can't make your monthly payment. And that's really where I'm going to wrap up with today. So if you're one of the 10 people watching live right now and you have questions about anything I've talked about or other questions about anything related to what is a mortgage and how does it work, please post them right now. I got extra time and I'm happy to address it. If you're not watching live, post your questions anyway, and I'll come back and copy and comment on them later. But the first thing is the servicer is your conduit for communication. So when you have a problem, talk to your servicer. You need to make sure that your servicer, they're going to call you, answer the phone, okay? Talk to the servicer about what your problem is, because hiding from them doesn't make a problem any better. So if you're running into a challenge, and here's why I'm saying this, because I believe that we are heading into a recession. I believe that we've got a lot of challenges ahead of us as an economy. I think we're going to be great on the other side of it. I think it's going to be bumpy as we go through it. And the fact is that there's some people who are going to lose their job. And that's horrible. And I don't want you to think that I do not believe that's going to mean that we're leading to a crash, because some people losing their job means some of them are going to have a good amount of equity in their home and they can just sell it. Other people are going to have very little equity in their home because they just bought recently and they're going to lose their job and they're going to lose their home. And that's horrible for those people. It's horrible for anybody that happens to. But it's not going to become a pandemic like it was in 2008. Because in 2008, we had people losing homes and their neighbor didn't have a fixed rate mortgage. And the neighbor had to refinance and couldn't because housing prices were dropping. So why am I talking about this? Because A, we're going to hit more challenges and people are going to have more challenges with their loan payments. Very much like the problems that we had back in 2020 with COVID, but for different reasons, obviously, than just the COVID challenges. We're going to run into challenges over the next couple of years as we go through this recession with people losing their jobs. I want to make sure that you have the right tools. Hopefully it's not you, but maybe it's a friend or a family member and you tell them the right thing. As soon as you think there's a problem, call your servicer. You need to make sure that you're talking to that servicer and that you're explaining what's going on and asking them, what can you do to help me? I'm going to go through a couple of the scenarios of what they can do to help you. So first of all is a forbearance. Forbearance was a word most people didn't know until 2 years ago, and now it's common for people to hear the word and throw around the word forbearance. And before I talk about why a bank would do a forbearance, I want to be really, really clear. The servicer's job is to find a win for you and for the investor. But if they're in a situation where ultimately they can only make you happy or the investor happy, they work for the investor. What does that mean? When the rubber meets the road, if you can't afford to make any payment at all, you have zero income coming in, they're not going to let you try. They're not going to lower your payment because you're logically, hey, I've got a $3,000 a month mortgage payment, and if you lower it to $2,000, it'll be easier for me to pay it. But if you don't have income to pay for the $2,000, they're not going to do that. They've got to know that you can sustain the $2,000 a month payment they lower it to, and then make sure the investor realizes or agrees that, hey, giving up $1,000 a month right now is better than losing on the entire transaction. So a forbearance is a postponement of paying back the money. A forbearance allows you extra time because, hey, I lost my job. I feel like I need 3 to 6 months to get new training and find a job in a new industry that has really good demand. And so maybe a bank's going to be willing to do a forbearance for that time, and they postpone those payments and put them at the end of the loan. That's a pretty common workout scenario that if it needed to happen, you have the opportunity to do that. The second thing is a modification. So a modification is the bank saying, look, I know you can't afford the $3,000 a month that you're supposed to pay, but I know you can afford $2,200. And so we're going to modify your loan and we're going to lower your interest or postpone part of your principal to get your payment down. Lots of different types of modifications. Some of them in the past had principal forgiveness in them, but that really happened because the housing market crashed and prices went down so much. And banks thought, you know what? If I end up taking this house back in foreclosure, I'm going to lose $100,000 because the equity has dropped so much. But if I do a principal reduction modification for this person, I only lose $50,000. Better to lose 50 than to lose 100. But if prices are not dropping drastically like they did in 2008, and by the way, prices have a lot of room to drop before they really start impacting mortgage balances being underwater. We saw such a high rise in home values over the last few years that most people have a significant amount of equity. So most banks are not just going to, most servicers are not just going to say, hey, I'll give you a principal reduction because I want to be nice to you. What they're trying to do is to save the investor money, because if the investor was going to lose 100 and instead they could just give you 50, that's a win for everybody. So modification comes in many shapes and sizes, and rarely are they long-term solutions. Most modifications are short-term. Most modifications are a Band-Aid to get you through, and then hopefully things are better. They're kicking the can down the road. So you have to weigh sometimes, hey, am I better off selling the house right now and pocketing the equity that I have instead of taking a modification and hoping that things get better? I can't tell you which is the right answer, but I can tell you it's something that you need to be aware of. The final thing is what's called a deed in lieu of foreclosure. Now, a deed in lieu of foreclosure is basically you saying, okay, I give up. I can't make the monthly mortgage payment. We're not going to modify the loan. And I can't sell the house because there's just not enough equity in there for me to sell it and walk away with anything. So I'm just going to sign the house over to the bank. Okay. It's you volunteering to give the property back. Here's the bad news. It's still a foreclosure. But the good news is that it's not a foreclosure that got drug out where the bank, it looks worse on your credit report when it is a traditional foreclosure than a deed in lieu. So if you ever end up in that situation where you don't have enough equity to sell the house, they won't do a modification for you and you're not going to be able to continue making the payment, ask about a deed in lieu of foreclosure, because that has you at least proactively saying, I'm giving the house back to you, but recognize that doesn't absolve you of the negative hit on your credit report. All right, gang, I've covered a lot of information today about what is a mortgage. It's a fun topic for me. For some people, it's boring. I don't know, but I think that the inner workings of the mortgage world go a lot deeper than what we talked about today. My goal was simply to give you a high-level overview of how the pieces work together, what paperwork it is that you're signing, where the money comes from, and what happens if you can't make your payment, and how does that process work. The reality is that a mortgage is a complicated thing that you need an advisor to guide you through that process, and I am applying for that job. I would like to be your family mortgage advisor to help guide you with every question that you have, every need that you have. So please reach out to me with any questions that you have, and just know that I'll be here to take great care of you. Thanks everybody for joining. Have a wonderful weekend, and we'll talk to you soon.